Hello, everyone, and welcome to the panel session on the opportunities and the challenges in the green bond market. My name's Andy Wilde. I'm the Global Chair of Financial Services at Edelman, which is the world's largest PR and communications firm. We work for some of the best-known asset managers and asset owners in the world, and I suspect it'll come as no surprise to absolutely anyone at this conference that sustainable finance is a major focus for each and every one of our clients. So I'm delighted to have the opportunity to chair the panel today and to hear from our extremely august panelists. I'll give a short line or two of introduction to the speakers before we get into the discussion. So first, Dr. Victoria Barbary is Director of Strategy and Communications at the International Forum of Sovereign Wealth Funds. This is, as the name suggests, the voluntary collective of some of the world's largest and also some of the emerging sovereign wealth funds. At the IFSWF, Victoria curates its knowledge sharing program and as well as leading the forum's research program. And prior to joining the forum, Victoria was the director of Investec Asset Management's Investment Institute, which is the strategic insights and thought leadership platform of the asset manager. Robert Parker chairs the Asset Management and Investors Council at the International Capital Markets Association, or ICMA, as most of you will know it. ICMA is the industry body dedicated to promoting resilient and well-functioning international debt securities markets, with, I think, around 600 members today. I may have undershot that. Bob can correct me. He's had a long and distinguished career in asset management, including at Rothschild and Credit Suisse, with a focus on macroeconomic and capital markets research. And last but not least, Jean-Marie Masse. Jean-Marie joined Blue Like an Orange, which is one of the pioneers of sustainable investing, in 2021, with a mandate to create and develop what they're calling Neptune Sustainable Capital. Neptune will be an ESG-driven fixed income platform, which is designed to provide advanced knowledge to structure funds, which will channel capital from developed markets into emerging markets, with the ultimate view of enhancing the UN Sustainable Development Goals. Previously, Jean-Marie was at the International Finance Corporation, part of the World Bank, for more than 25 years. And he held a series of leadership positions there, most recently as Chief Investment Officer of its Financial Institutions Group in Washington, D.C. During his time there, he had a string of awards and accolades, which is far too long to mention here. But one achievement which I think is pertinent to today's discussion is that he conceptualized, when he was there, the Amundi Planet Emerging Green One Fund, which I think is still today the world's largest emerging market green bond fund. So without further ado, let's get into the discussion. Jean-Marie, I'll start with you. Given your long history in the green bond market, perhaps you could give us an overview of where we are today in the green bond market and where you see it heading in the future.
All right, so thank you. So where we are today, I would say the first green bond was issued in 2007. So we are 15 years since the initial issuance of a green bond. And that year, it was one green bond was issued by European Investment Bank in Luxembourg, and one green bond was issued by the World Bank. That was the inauguration issuance. Okay. Then along the way, the concept is to issue a bond with use of proceeds to finance certain objectives which are good for the planet, basically low carbon emission projects. Then came the COP21 in fall 2015, which has endorsed green bonds as an effective tool to channel money at scale from developed market to emerging market to meet goals of the COP21 and reduce the consequences of climate change in emerging markets, for example, or in developed markets as well. Subsequently, we saw a sharp rise of green bond issuances post COP21. So in 2015, the green bond issuance was about $65 billion for the year, and total outstanding was $220 billion. And if we fast track to 2021, then the green bond issuance became $400 billion, and the total outstanding green bond market became $1.5 trillion about. So it's a fast track growth. Now what has happened is that in 2017, in 2019, it was felt that we need to have a broader scope than just green bonds. So then came the concept of social bond and sustainability bond. So social bond, like green bond, is use of proceed product, but to finance social activities like school, hospitals, public transport. And then sustainability bond is a blend of social and green bond. So now we have a collection of three categories of use of proceed bonds. Okay, and while green bonds were 400 billion issuance last year, the three combined were very close to 1 trillion of issuance. And social bond picked up partly because of COVID, because a lot of vaccine program could be financed via social bonds. So we are experiencing a vast growth of this market. And if I look at forecast for 2022, combined, first of all, the forecast for green bond is 600 billion versus 400 billion last year, so quite a rise. And all the products combined will reach $1 trillion of new issuance this year, 2022, based on forecast. So it's a product which is really picking up. So that's one thing. When you ask me where we come from, where we are going, it's a fast track growth. Now we should understand that there are use of proceed products. So when investors buy this bond, they know where their money will go. And it is governed by ICMA, Green Social Sustainability Bond Framework and Principles, where each issuer has to do a framework at issuer level, plus second opinion at time of issuance, plus annual impact reporting. So there is a system around it to provide some integrity. Okay, and that would be my last point. What is happening is that we realize that use of proceed products were good for those who have eligible assets to use the proceeds. But then if we want to achieve a transition in the world, we need also to address those who don't have necessarily green assets to finance via bonds. So came this new product called sustainability-linked bonds, which are a bond with key performance indicator, KPI, applied at issuer level. So an issuer issue a bond, commit to over time to certain KPIs. And if the issuer meet the KPI, there will be a consequences on the bond coupon. So it could be either an increase or decrease of the bond, depending of what is agreed at the time of issuance. So that you see the evolution. Okay.
And I think this is probably quite a good juncture to go to Robert. You know, given you talked about ICMA being a standard setter for this market, and if we're moving to if the future looks like sustainability-linked bonds where you have KPIs that are set, that if you miss those KPIs, there's a financial penalty of some sort. I mean, I guess the logical question is, you know, is there a good framework to set these targets? You know, who is setting the KPIs and making sure that the issuer actually hits them? You know, are we in danger, I suppose, of having a situation in a market which is proliferating very quickly, that the issuers effectively are marking their own homework? You know, Robert, do you have any thoughts on that?
Well, ICMA has spent, as Jean-Marie mentioned, many years developing green bond principles, and then more recently, a framework for the principles on social bonds and sustainability bonds. And ICMA obviously has been working very closely with regulators, whether it's at a global level, IOSCO, whether it's at a European level, the EU Commission, or ESMA, the European Securities Markets Authority, to make sure that there is buy-in from the regulators and therefore investors and issuers to those bond principles. I think, to be blunt, I think there is work to be done to make sure that those principles become global. And ideally, I would hope that in a couple of years' time, we're going to be having a discussion where there is global buy-in to those principles. Now, in terms of certification and KPIs, which you want to discuss, I think there are a number of different levels. The first level is an issue compliant with the ICMA principles. Secondly, there are a number of organizations, whether it be some of the credit rating agencies or MSCI, which assign ESG quality standards or criteria to bond issues. And although it's in equity space, if you look, for example, at the iShares Global Clean Energy ETF, that has an MSCI quality score. So that gives investors assurance as to whether their funds are actually being invested in projects and investments which are compliant with the principles. I mentioned the regulators, and recently we've had actually a number of incidents where regulators have actually warned organizations about greenwashing. And it's very important in this whole area that asset managers and investments are compliant with what investors are being told that they're investing in. So, the regulatory aspect is very important. In terms of certifying KPIs, obviously that is a role for specialist certification companies, and obviously accountancy firms have a key role to play here.
Vicky, I think, before I ask you directly about some of your key constituents, the sovereign wealth funds, do you have any final sort of reactions to that discussion around KPIs? It may be a slightly separate discussion for the sovereign wealth fund community.
Yeah, I think all of this concern about a lack of regulation and standards is one of the things that when we spoke to our members, they really brought up and said there isn't enough regulation or standardization. And certainly when you look at there's a very long list of standards for green bonds, around the world. So everything from China through to Europe. And I think that there is going back to Robert's point, that there needs to be some form of global standard for these guys, for these big investors to really be comfortable with that, with understanding that market has now matured. So I do think that is a very relevant, concern and point in terms of looking at sovereign wealth funds' interest in this asset class.
And staying with that point, because I think you're sort of alluding to it, is the recency of the asset class. Jean-Marie mentioned it was born about 15 years ago, and it's going through an explosion of growth and a rapid change and development. Are questions around regulation, standardization, liquidity, and so on, are you finding that they are sort of deterrents for some of your members to embrace green bonds?
Yeah, so when we did a survey of our members back in February, so last month, and we were, effectively we said, most of the respondents said this is a very immature market, and we're not very sure about it. And if you think about the type of investors that sovereign wealth funds are, they have a fiduciary responsibility to their government and their stakeholders and their citizens. So often they aren't kind of first movers in these newer spaces. And while to some people, you say, well, this market has been around since 2007. I think that there is that there is still, compared to other asset classes, like even if you look at private equity and infrastructure, which have been around since the 1990s, sovereign wealth funds didn't pick up on those until the mid 2000s. So I do think that, they are reticent to be involved in newer markets. And yes, so it was definitely, that was the primary concern. It was an immature market, and that, they're looking to get, to understand it better and find the skills in-house to kind of, as we've just been talking about, know that their money is going where it says it's going to go, before we, really before they're going to be comfortable with being big allocators to it. And so, when we did our survey, most of them said, well, we're not looking at it at the moment, but there was definitely some interest, but only 1 out of 10 was currently was currently allocating to those to green bonds. So it's definitely an issue around the immaturity of the market, I think, for them. And as I said, I know this is about, they, as I said, they do have this fiduciary duty to governments, and so they are going to be more cautious and conservative around these types of newer asset classes than perhaps the commentariat would like.
Yeah, no, it'll be fascinating to see how, if and how, that kind of situation changes within the sovereign wealth fund community. But I mean, perhaps just going back to Robert for a moment, and then to Jean-Marie after that. I mean, this is a market which is experiencing a huge amount of growth. If that kind of appetite is not being driven by the sovereign wealth funds, it's being driven by different types of asset owner. And obviously the different types of asset owners have different kind of investment kind of objectives in mind. Robert, do you have any thoughts on the European pension funds, UK pension funds, insurance companies, and where the demand is coming from, and and maybe the advantages that they see in the green bond market?
Before I talk about different investor types, let me just follow up very briefly on Vicky's comment on market maturity and the sovereign wealth fund's perception of lack of market maturity. And I think one can look at a number of criteria on when a capital market becomes mature. And the first one is obviously diversity of issuer. So whether it's sovereigns, supranationals, and corporates. And one aspect of the green bond market obviously has been the development of the corporate sector as an issuer. So that's diversity of issuers, criteria number one. Criteria number two is the sort of development of a yield curve. And initially, immature markets, typically, there are short maturities, issuers cluster at sort of up to 5 years, whereas a mature market, will go out to sort of 30 years plus in terms of maturity. And then I think just sort of two other criteria I just mentioned, which is liquidity. And, as to whether, investors have the ability to buy and sell on, economic spreads between bid and offer. And, a mature market obviously is a very liquid and cost-efficient market. And then the other point is risk transparency. And, a point that all of us have raised is absolutely critical that investors have complete risk transparency on where funds are being applied. Now, coming back to your question about investor types, clearly we have the retail market, which is mutual funds and ETFs. And Jean-Marie has commented or alluded to that area. On the institutional side, other than sovereign wealth funds, the institutional side is dominated by pension funds, insurance companies, and then charities and endowments. And I think one aspect of the sort of charities and endowment sector is a commitment by most that they are disinvesting from fossil fuel investments. And I think that is a very powerful trend. In terms of insurance companies and pension funds, obviously they all have very long-term investments, and therefore actually liquidity for them, if you've got a sort of 30-year liability, liquidity is actually less of an issue. It's almost a sort of buy and hold. But those, whether it's European pension funds, I would say that there is probably a greater push into the ESG sector by the European insurance companies, who do seem to be taking the lead on this. And coming back to our friends in Asia who are listening to us, I'm assuming that we will see over the next 5 long-term years, a move by Asian insurance companies and pension funds into increasing asset allocation to ESG. But I think the overall theme on pension funds and insurance companies is that the liabilities are very long-term. So that helps actually the development of the long-term issuance of green bonds and green-linked bonds.
Yeah, and I would just say I think that's a very similar position to sovereign wealth funds. If you think of a lot of the big international sovereign wealth funds that invest abroad, they've got 30, 50 year plus investment horizons. So going back to Robert's point about that yield curve, they're not looking. They are looking to get to take that illiquidity risk to get a better premium. And obviously, at the moment, when, as Robert was saying, that you've got an average coupon of 3 to 5 years, that's not a particularly, it's not so attractive to a sovereign wealth fund that doesn't need the liquidity. So I think that, that's one of the key issues, I think, for some of these larger, longer term institutions for allocating more to green bonds.
And just on that point, perhaps Jean-Marie, if you could pick up briefly, in the sense that you work for, a leading sustainable investor, but in terms of the flows that you're getting, where are you seeing them coming from, and in particular, are you seeing many flows from Asian institutions? Robert just mentioned.
Okay. What I would like is to build on what has been said before to discuss why issue sustainability bond at issuer level, and also broaden the topic of green bond to SDG investment themes. And then after we speak to investors. So when we look at the size of the global public debt and public equity market, the public debt market is $124 trillion outstanding, and the equity market is $95 trillion outstanding. The sustainable bond market outstanding is estimated at $3.4 trillion. So it's only 2.74% of the global bond market. So what we are observing is that it's very tiny. And if we look at emerging market, it's $700 billion, and more than 50% come from China. So it's even tinier. Okay, so it's very difficult to have an investment strategy targeting only green bonds, because your market will not be diversified enough for investment strategy. In addition to all the points made by Robert before about liquidity. So what we are observing is more a trend of investors wanting to invest on SDG themes. And what they see is green bond is la crème de la crème of SDGs, but they need to have a broader scope of eligible investment universe. Okay, so that's one thing. The other thing we should look at is that all the money on green bond, they finance low carbon economy. So a lot of investors in Europe make commitment to net zero degree contribution in their investment portfolio. So it's a product which could fit well this kind of commitment, because in the annual reporting by issuer, you have data on per $1 million invested, how much ton of carbon emission you are reducing. Okay, so you have these two dimensions. Now the third element is about transparency, the point raised by Robert. So there is a study which has been published in 2 years in a row, in 2020, 2021, which specifically look at the quality of annual impact reporting by green bond issuers to investors. And it's a survey made at issuer level and at investor level. And basically, 80% of investors say impact reporting is very important for them, but then 66% of investors says it's inadequate. So what it means is that a lot of time is spent by the issuer and by the investors on products which are not of good enough and good quality. So it's also reflect the nascent nature of that market and the need for more standardization on green bond in order to cut transaction cost and make it more easy to do. Okay, so we are to me we are in a nascent market, even though it's growing fast, but the growth will bring more and more talent to that asset class, more and more best practice, which then we need to be disseminated to educate the market and make it more efficient. Okay? When it comes to investors' appetite, what we are observing is that it's still a market very much dominated by European investors, more than Asian investors. Yeah? But what we are seeing is more and more interest from Asia. It's picking up. And Asia is also a very big, fast-growing bond market. So naturally, green bond will have their fair share of bond market globally. Okay? So Asia is picking up. And now when it comes to Europe, first of all, a lot of push on issuance level at sovereign level. And like France, German, Netherlands, they're issuing green bond. And also the European Union has a vast program to issue a lot of green bonds. The European Central Bank also is favoring green bonds issuance and investments. So there is a consensus in Europe that it has to happen. And I think it's also linked with what is happening at population level with election, and you have more and more votes going for population to save the planet, these kind of things. So I see Europe as a thought leader at this current stage of the market development. Okay, so that's where we are. And I expect that, for example, I was reading in today's newspaper, Tesla has opened a vast plant near Berlin. They have 3,000 people working. They plan to hire 12,000 people in that plant near Berlin to do electric cars and car batteries. So this new economy, low carbon transport solution is creating jobs, creating research, and will attract more and more talent. So that's where the world is going. So I do expect it will move toward that. And green bond maybe will remain la crème de la crème, but it will not be the solution for everything, because you need to involve issuers who don't have green assets.
And we've talked quite a bit about the growth in issuance. We've talked about the huge growth in demand, perhaps led in Europe but growing in Asia, and bubbling under within the sovereign wealth community. I just wanted to have a look at the outlook for the rate of return, and perhaps we'll come to Robert on this one first, because I'm not positing a green bubble per se, but obviously when there's huge demand and crowding in certain asset classes, and this is not just the bond market. You mentioned, Robert, the large iShares ETF, about ESG investing generally. Is there a risk that the upside for investors just begins to diminish over time as more and more people move into the same assets?
I think the first point to make is that, although the focus of this discussion is obviously the green bond market and linked to that social and sustainability bonds, but investors are looking at the whole asset class universe. So whether it be credit markets, green loans, private placements, the private placement market in green finance is becoming increasingly important. And then obviously public listed equity, private equity, and also an area which is increasingly important is funds going into infrastructure projects, and that's particularly in water management, renewable energy, and transport systems. So green bonds is actually sort of a subpart of a whole universe of asset classes linked to trying to improve climate change that investors are looking at. Now, in the fixed income markets, obviously the current environment for fixed income investors is very challenging indeed. First of all, we have got central banks tightening monetary policies. And we've seen that very clearly from the US Federal Reserve in recent weeks. Linked to that, we have got rising bond yields. So, if we just look at Europe, whereas Asian bond yields have been reasonably stable, in Europe, 10-year German government bond yields since the end of February have gone from a negative yield to currently trading at 50 basis points. And we've got 10-year US Treasury yields at 2.4. So, although at some stage the uptrend in bond yields will end, and we will have more stable markets, certainly in the short term, the outlook is for higher yields and therefore, mark-to-market losses on longer duration investments. Now, one aspect, obviously, which has been a point of concern for investors is that with, as you mentioned, Andy, with the weight of investor cash flow going into green bonds, will we see green bonds, trading at a premium, i.e. a yield discount to conventional bonds? And the answer to that is we have seen short-term periods where green bonds have a lower yield than conventional bonds. But I would emphasize it's typically been very short-term. And, when actually broadly seeing green bonds trade in line with conventional bonds. Having said that, the weight of money, I think, is reasonably clear. And, as market participants and as investors, obviously a point of concern is we do not want what you refer to as a green bond market bubble. Because as we all know, market bubbles, I hate the word guarantee, but I can guarantee that whenever there's a market bubble, it ends in tears.
Well, it's something that the press have been very, very hot on, and speaking of which, I did want to quickly return to the other term, the media return again and again to that of greenwashing, because we've got a couple of questions actually from audience members, and maybe I'll come to Jean-Marie and Victoria on this. I mean, a couple of broad questions around the dangers of greenwashing, and whether or not kind of ESG focused funds and green bond focused funds really make a difference, or whether they are kind of nice branding around something fairly generic. And the example that I'd give on that is, there was a piece in the FT a couple of days ago. An airport is being built in Asia, and it's being built out of sustainable materials, and they've issued a green bond in order to build the airport, but it's still an airport, which is not the greenest of assets, and it's also being built in a location which will apparently endanger the indigenous population of white dolphins, and therefore it's attracted quite a lot of opprobrium. But that is a green bond that is financing that development. So, trying to wrap up a couple of these questions from the audience. I mean, do examples like this undermine investor confidence in the asset class? Is this another reason why global standards are incredibly important, and perhaps more action at a regulatory level? Jean-Marie, perhaps you could give some thoughts on that.
Yes, so I would like to start by saying that from a credit risk standpoint, there is at balance sheet level, there is no difference technically between green bond and plain vanilla bond. It's the same cash flow as the company which is servicing the bonds, whether green or plain vanilla. So whether it's green or not, you need to do your credit risk analysis. For example, in the case of the airport you mentioned. Okay. The second point is that it is quite demonstrated by ICMA research that once an issuer issues a green bond for the first time, it becomes a repeat green bond issuer. So that's why I believe it will grow this market. Point one. Point two, it's also well demonstrated that green bonds are more oversubscribed than plain vanilla bonds. So I have very detailed proof of that at issuer level I worked with in the past. So what it means is that if, from an issuer standpoint, if you issue a green bond, you can have more investors in your bond because it's oversubscribed. You can also have sometimes thinner price. Okay. So now, is it a bubble? In my view, it depends because when you issue a green bond, it's also a way to signal to your employee and to your investor that you care about the planet, and it can reorient your strategy to finance greener activities. So one of the asset class I like to use as an example is green buildings. Because today, if you want to build a building, you are better off to make it green than not green because the difference in cost is minimum. But if it's green, it holds its value better, it runs faster, and the operating costs are less than non-green because you consume less water, less energy, because you have more efficient boiler, more efficient air conditioning. So let's suppose you are a bank, you want to finance building sector. If you have a portfolio with green buildings instead of non-green building, your collateral has more value. So it's a better strategy relative to your peers. So it could justify why you want to go toward that kind of bonds rather than plain vanilla bond from anybody. There is also another correlation which we see nascent, is that if, let's suppose you have a country, you have 5 banks, one issue green bond, 4 are not issuing green bond. If the banks are all listed, the one who is issuing green bond can increase its chances to be included in a sustainability equity index. So you have this correlation also that you will never have with a plain vanilla bond. So you see, it's a much more complex than black or white. Okay. So now, when it comes to greenwashing, I think that one of the issues is the need for robust, credible database to govern that market. So there are more and more coming, but it's not totally there yet. And everybody is aware of that. There is that particular need, and it's all about market standardization. So my view is that it's not because it's green you should buy it. You should check how green it is, what quality of transparency you have from the issuer, what commitment you have at issuer level, and the market will grow and standardized.
Yeah.
And Victoria, I mean, just to come to you for a moment, that really does pick up on something that you said earlier on, which is, a lack of standardization and a couple of the and lack of clarity around what maybe the regulatory outlook for these investment vehicles might be has been a kind of something of a deterrent to your members. And do you think that if that situation would change, if there were greater standardization, there might be a willingness on the part of the sovereign wealth funds to sort of look a bit closer in the near term at the green bond and the sustainability linked bond market?
Yes, so I mean, I think what Jean-Marie was just saying is really relevant and around this point is that sovereign wealth funds over the past 2 years have really accelerated their ESG integration. So when they are looking at any bond, quite often they're looking at it at an issuer level rather than at the bond level. So they're using those standard ESG criteria across their whole portfolio. So you're in a situation where the issuer is being judged rather than against a standard set of ESG criteria. And so I think that when it comes to green bonds, having a set standard that is the one you use, I think is going to be very helpful, because, you know, that is going to give them greater comfort with investing in these, as Jean-Marie was saying, that the use of proceeds is going to be used accurately. But I think that once you've got proper standards, then it becomes easier to integrate this across your portfolio, because I don't think any of our the people we spoke to or any of the respondents to our survey actually said they thought this was a separate asset class specifically. You know, it is part of their fixed income portfolio. So essentially, those criteria are going to be, are going to be the same across the entire universe of fixed income in which they invest. So those standards is really going to facilitate rolling that in, because as Jean-Marie was saying, you know, you're going to get more of these because of the, you know, and as he was saying, at the balance sheet level, there really isn't, on the credit risk side, there's no difference. And sovereign wealth funds are judging green bonds at exactly the same criteria and parameters that they're judging every other fixed income instrument that they invest in. So I think as you've got those standards, it's going to make it easier for them to allocate more. And as green bonds become, as you say, a bigger part and less of a niche investment, then I think as the market grows, matures, that the standards, etc., it all kind of flows together. But I think it's really important to kind of note that from my members' standpoint, that they're judging these instruments through the same criteria that they judge the rest of their fixed income portfolio, and that includes ESG, screening and criteria. But you're going to pick it. So, but that standardization is going to be key to that.
Yeah, and that picks up on a point that Robert was making earlier. I'm conscious that the time marches on. I want to stay with you, Victoria, for one minute. A follow-up question to that, and then I'll have a final question for the panelists. But and we've spoken, Victoria, with your members in relation to them buying green bonds. Yeah. I mean, clearly there is the room for sovereign wealth funds to be issuers themselves. Is that something that you foresee?
So when we spoke to our members, so there is a group. So just for the people watching, whilst we tend to think of sovereign wealth funds as these big oil funds that invest abroad, there is a group of sovereign wealth funds, and they're becoming more common, that have an illiquid asset base, so SOEs or assets otherwise given to them by the government to invest at home for sustainable development purposes. And certainly, I think that for those funds that like Mubadala, like Temasek, that already Khazanah in Malaysia, that already have an active bond, or Sukuk in Khazanah's case, program, that's perfectly possible. And in fact, Khazanah did actually raise a social bond back in 2015 for educational and school purposes. So I think that that's possibly in the kind of short to medium term, where if a sovereign wealth fund is partnering to develop, say, solar energy plant or whatever, that those are going to be that kind of green bond could be a potential. And those issuances are probably, because they've got the sovereign guarantee, are probably going to be quite sizable. So going back to Jean-Marie's point, and that they're going to be large issuances, and they're potentially, as Jean-Marie was saying, that they could be repeats as well. So when we spoke to when we did speak to sovereign wealth funds, those kind of types of sovereign wealth funds were like, yes, well, if we have a project that is in line with international standards, then that's perfectly possible for us to do. So I definitely think that that's something. It's not kind of inevitable, but it's definitely something to look out for in the coming years.
Thanks for that. And with a minute on the clock, I think I'll go to Robert and then to Jean-Marie, and just a sort of a final word. It seems odd to have a discussion about anything to do with global markets without referencing, the awful events in Ukraine. Obviously, we saw how the COVID crisis became something of an accelerant in terms of investment into more sustainable asset classes, with a lot of economies attempting to reduce their dependency on Russia for oil and natural gas, when clearly Germany front and center of that group. And do you think that the war in Ukraine will be a similar accelerant to COVID, both on the supply and demand side for green finance? Robert?
I think just one example of where there is a correlation between investment performance and environmental resources is what's happened since the 24th of February in European equity markets. And I would just highlight that the top two European performing equity markets are Denmark and Portugal. And two characteristics of the Danish market and the Portuguese market are, number one, that their reliance on Russian oil and gas is minimal. And secondly, their energy base for those two countries is very heavily dependent on renewables, and in both cases, the wind sector. So there is a very good correlation, I think, between where you're getting your energy from and investment performance. Now, coming back to your question, I think just sort of two observations. The first observation is that, and we've seen this very clearly in policy statements from the EU, that there is a renewed push and acceleration into developing more European energy reliance on renewables, whether it be wind, whether it be solar, whether it be hydro, etc. I think the second is the need to diversify energy sources. And we've very clearly seen that in the case of Europe. And in fact, in the last month, we have had a record number, 28 in fact, of large LNG carriers coming from the States to Europe to reduce dependence on Russian gas and to increase dependence on American gas. So, push into renewables, diversity of resources. Now, there is a slightly negative and controversial aspect to this, is that certain countries, and notably France, has said, listen, we have a very strong nuclear industry, and one way of minimizing our dependence on Russian energy sources is obviously to further develop our nuclear industry, and one can have a very long debate about the environmental impact there. The other negative, of course, is potentially countries going slow on eliminating coal as an energy source. So now that is one negative to be looked at. But the overall themes are diversity of resources and a push into renewables.
And
Right.
20 seconds, Jean-Marie?
Yes, so I would like to start by saying that most ESG investment strategies apply an exclusion list. And Russia is in the exclusion list for a while since the Crimea invasion. So those funds who apply this exclusion list on Russia should not be impacted necessarily if the situation in Russia deteriorates on the debt capital market or equity market. So that's one point. Second point, if we look at the theme of green bond use of proceeds, a lot of it is low carbon economy, which means reducing energy consumption via energy efficiency investment and production of renewable energy. So it goes in the direction of more self-sufficiency, like Denmark or Portugal, at country level. And so I believe that it just reinforced the importance of investment in those asset types. So I do believe that the current crisis could accelerate projects in that space. The COVID showed that we could produce vaccine in record time if there is a willingness and capacity put behind such goals. So maybe we can see similar thing in the sustainable finance field, particularly in Europe. And from there, because we said many times that it was nascent, but at the end, the more volume you have, the cheaper the price becomes per unit level. So I think it will accelerate this development and lower the break-even point for those investments.
Well, I'm conscious we're 3 or 4 minutes now over time. So before we get the old shepherd's hook and we're forced off stage, it only remains for me to say thank you so much to the panelists. Thank you, Jean-Marie Masse. Thank you, Robert Parker, and thank you, Dr. Victoria Barbary. And I hope everyone attending the conference enjoys the rest of it. Thanks, everyone.
Thank you.
Thank you.